very honored to have Viven Wang, a Deloitte partner, to join us tonight to give us a talk about how to hack the cross-border finance. I know sometimes it can be tricky because entrepreneurs, whether they start in China or in the US, but once involved in the cross-border domain, things can be very hectic. So Viven? Hi, Viven.
Yes, I need to unmute myself.
Great.
Thank you, Ifu, and thanks, Deloitte, for having us. So I have a couple of my colleagues on the line. Would you mind to project our presentation? So again, it's my pleasure to be here. I will be presenting for the next, let's say, 45 minutes on a series of international cross-border setup, finance and tax issues for startup companies, especially startup company active in the U.S. and China trade or U.S.-China sort of businesses. So a little bit about myself. I'm an international tax partner based in our Deloitte San Jose office. I've been with Deloitte for almost 23 years, quite a long time. I guess for Silicon Valley, this is probably a pretty long tenure at one organization. So my background and expertise is in tax law and more specifically international tax law. And why we think for startup company, this is very important is a lot of time when you're talking about setting up your company from a finance perspective, it's all about what is the structure make most sense, make you most flexible to raise money from financing perspective, and then at the same time, what is the right structure to manage cross-border operations, and all of that has a very significant implication from a tax perspective, because as soon as you cross-border, every jurisdiction is going to want to have their own laws to apply. I understand you guys has went through the legal sections a few weeks ago with King and Wood team, and certainly you heard from a legal perspective. Today we're going to be flip over and have a little bit more focus in terms of finance and tax lens, and this will cover both corporate considerations, your company considerations, as well as you as an individual, whether or not you're a U.S. person, U.S. citizen, U.S. green card holder, or Chinese entrepreneur living in work in China. All of that will be relevant once you set up operation cross-border. There are international tax implications for you personally as well. So we will touch base a little bit about that as well. So together with me, I have my senior manager, Carrie Shao, who has also worked at Deloitte for a very long time. Carrie, say hi, please.
Hi, everyone. I've been with Deloitte for 14 years.
Yeah, so Carrie focused quite a lot on the executive as well as sort of a family office side of the tax matters. So she will also present few of the key issues as we're talking through some of the individual income tax considerations. Without further ado, please let's go to the content. So common corporate structure, I think few of you, if you have chat with your legal counsel or advisors as to what should I do in terms of set up company, these are probably the all options possible out there for startup company which have heavy footprint or heavy potential sort of investor base both in US and China. Cayman structure is very, very, very popular, especially in the last 10, 15 years. Initially was due to tax reason. Really, Cayman can park IP, obviously was very low tax jurisdiction. And later on, especially in the last couple of years, it's really due to US-China trade conflicts. A lot of time companies are sort of a pick and choose. It's very hard to pick and choose as to what foot you should be standing on. So having a Cayman holding company tends to be a little bit more neutral. Another key reason for Cayman holding company to be popular is its flexibility for future exit. So as a Cayman company, it's much easier for it to go public on Hong Kong Stock Exchange, Singapore Stock Exchange. It can also go public on NASDAQ or New York Stock Exchange. And such structure is also much easier to flip into a China IPO arrangement. 我们叫做拆红筹架构. So that's a very popular structure. But at the same, the other few is also popular as well. There are variety of legal, tax, and finance reasons for it. So in today's presentation, we will talk about mainly is how do you switch back and forth between those structures, a little bit about pros and cons at the corporate level as well as individual level of each of those structure. And the way we're going to present that is going through 3 major scenarios. And these scenarios are the ones that the legal team has gone through a couple weeks ago with the team as well. Zoe, please, next page. So very quickly, Carrie, you want to just read through the scenarios?
Sure. We understand that last time with the legal counsel, you guys talked about the 3 scenarios. So that covers scenario 1, when you are a startup CEO and you're going to have your own stock and you're going to set up option pools, grant options, and VCs are invested, wants to make investment and they want you to move out of the US and reincorporate in the Cayman. Then scenario 2 is more like, okay, so now we focus in China and start operations, starting operations in China. Then let's convert a WFOE as a joint venture, and the RMB investors will invest in the WFOE directly. And scenario 3 would be what's the consequences if we have parallel operations, US and China. How can a structure provide flexibility in terms of IPO, and what would be the tax implications to the US shareholders as well as the companies? So these are the 3 focus we're going to talk about today. Let's go down to the next slide.
Yep. So yeah, I mean, as we're going through this, I will cover mostly the corporate considerations, and Carrie, feel free to chime in as you have some of the individual income tax comments. So in scenario number 1, by and large, is saying a startup company was already set up with a US headquarters structure. It might be set up yesterday, it might be set up 5 years ago. In any case, the entity is there, and you might already have some of the foreign subsidiary, or you might have nothing. On this chart here, we sort of illustrate that you already started to explore some of the international operations. Now, but there is an investor, whether or not from China or from any other jurisdiction, they view your company as a global company. They view your market as much more broader than US. They would prefer you to have a Cayman structure because all the benefit I mentioned earlier in terms of future exit and flexibility and potentially being viewed a little bit more neutral in this ever-changing political environment, global political environment. So what can you do? It could be done fairly simply. Simply is having the lawyer to set up a new Cayman company. We go through a reverse merger reorg, new Cayman company, set up a US Delaware, your current US Delaware, and the new US Delaware execute a merger. And then you flip, or the current shareholder go up to the Cayman level, investor can directly invest in the new Cayman entity. So it's fairly quick transaction, honestly speaking. From a legal perspective, there are certain things you need to iron out, specifically around legal ownership structures around options, as well as sort of different share rights, because Delaware law, even though it's similar to Cayman, but still have differences. And the KYC rules in Cayman is pretty complicated as well. So I would say, just if this is purely legal action, this can be done literally in 2 weeks. Okay, the complication comes is really around tax. Okay, so in most cases that I have dealt with, I have to say at least I have dealt with 30 of these kind of reorg in the last 18-month period during pandemic, basically. And in my career at Deloitte, 20-some years, we certainly have done way more of that. Probably 90% of those reorg is executed in the format where the new Cayman company continued to be a U.S. taxable entity. And that's really due to the operation of U.S. inversion rule. And on the note here, we call it Section 7874. Basically, U.S. government back in the 90s and later on reinforced in the 2000s, put forward this anti-inversion rule, basically prevents U.S. company to transfer substantial or asset or its shares into a foreign entity and just sort of expatriate. So in certain scenario, the scenario in this is basically you don't have new asset being participating in a deal. Cash is not considered a new asset. You have to really find an M&A deal to accommodate and consider a new asset. Assuming you don't have any new asset to participate, then the new Cayman holding company will still continue to be a U.S. taxable entity. And I would say nothing wrong with that. You know, by and large, most of the investors' intention to have a Cayman holding company, especially in today's environment, is not really for tax benefits. And I will touch upon that in later slide about why Cayman is no longer relevant for tax, because all the economic substance requirements in Cayman. So by and large, having Cayman to be considered as a U.S. tax entity, honestly, it's not a big deal. So as long as you can communicate clearly, we can get this done. Just Cayman as U.S. tax entity. Most of the foreign investor will say that's fine as long as I get all the other benefits. I can go public elsewhere, legally view more neutral, etc., etc. So you know, again, the point is you can this can be done, but for companies has significant amount of California tax residents, this is a little bit more complicated. This inversion rule 7874 somehow is not adopted into the California tax code, which make this transaction is not considered as domestic reorg, and basically for California purposes. So the transaction will be taxable for California unless the shareholder willing to take certain other positions. Okay, so in our tax world, it's always exception after exception. But again, for California companies, there are implications and implications specifically to shareholders. We certainly have other solutions to get around these rules, but likely going to be a little bit more complicated. And last but not least, to mention, there's a section 1202 for those of you understand qualified small business stock. If you're an entrepreneur, you hold a company stock in the U.S. company, your stock is considered qualified small business. If you are very successful, later on dispose the stock, and you will get $5 million exemption from federal income tax. But if you flip to a Cayman company, then that status will be terminated. Okay, so there is a potential loss on the 1202 benefit. It may or may not be as relevant to you. If the company is going to be so much more successful, 5 million may not be as crazy issue, but maybe some of your California or US investor might be concerned about this. So that's another item to consider. Last but not least, on this structure, just want to mention is having a Cayman holding company, that doesn't mean your IP is outside of Cayman. If you start with the US company, just putting box on top of US your IP, legally speaking, tax speaking, IP still in the US. You cannot say it's right pocket, left pocket issue. It's still two separate legal entities. So if one of the goal for you to have Cayman company is to get certain IP protections or other reasons outside the US, you will still have to do additional steps to move IP offshore. Similarly, if you don't want your China operation to be held under the US, you need to execute another sort of what we call out from under transaction as well. So with that, I mean, one thing is because the Cayman company is still a US taxable entity, from an individual tax perspective, there's nothing changed. Yeah, you as a founder, whether or not US or foreign, you're still considered as holding a US company. So in reality, nothing changed in terms of your tax status going forward. Next page. Sorry. So scenario 2, just recap, the question was basically your US company with some China business, and your investor come in and say they only want to invest in your China business. Okay, they're not interested in your US. This happens fairly often, whether or not it's because strategically they just think China is better, or foreign exchange control issues, the China investor cannot get cash out, or CFIUS issues, etc. So and we see this not only happening to startup companies, we actually see this happening to much bigger companies as well. So joint venture setup has been one of the most popular arrangements between US China businesses, especially in technology, life science industry in the last couple of years. So a typical arrangement is set up as US company will contribute IP in exchange for equity, and Chinese investor will put in hard cash for equity. The issues we typically run into, and this is critically important for people to understand, is when the US company contribute IP for equity, it is a taxable transaction to the US company. Okay, there are a couple ways to defer that tax, but that deferral it comes with a deemed royalty. Basically, again, you're just converting a immediate tax amount into a stream of income over, lifetime of IP. Okay, it's sort of you can think about if the IP was 50 million, you might be splitting that over 10 years, every year pick up 5 million. It's not exactly that number, but typically that's how it works. This get missed quite a lot. This is, if you're not working with people who are very familiar with the international tax law, and this issue get picked up all the time when the Chinese company go public in China. I help a lot of these structures go public in China, and Chinese SEC, they are very savvy these days about international issues. They as soon as they see the IP was originated from the US or another foreign country investor, they want to get tax clearance. They want to make sure that's actually, cleared foreign tax issues. So that is a critical issue to work around. It's very important to know that. For a lot of US company might have historical losses. You might be able to use those losses to shield the income, or we might have to think about some other more creative ideas to minimize the impact. So again, another piece of major issue in this structure, especially is issue for existing shareholders on this chart, is keep in mind, in this arrangement, existing shareholders not holding China joint venture stock. They're holding US company stock. Let's say your China joint venture become widely successful in China and went public. Gone public, have huge valuation in China. It's not necessarily easy for the US shareholder to get a piece of the pie directly. Okay, typically this will require further reorganization to put the existing shareholder down level through a variety of different structures to hold the China joint venture stock. And that restructure at later times typically also taxable transactions, either to the corporation or to the shareholders. So as you setting up the joint venture, let's really make sure and understand clearly what's the ultimate goal here. Is this just a commercial joint venture play, or this is really a spin-off? Eventually that joint venture going to go public. And if so, how do I benefit my current shareholders, including founders, employees of the US entity? That is actually a very, very, very complicated process to go through, both from a China law perspective, China tax and US tax, and then of course, legal perspective. I know the Ken Wood team covered a little bit about that as well. So we have done quite a lot of these restructurings recently, certainly have some pretty well thought through strategies, but regardless, each case are quite different, and there's still always a tax cost. Somehow, somewhere, we just can minimize it, or at least make sure everyone's aware of it, and we can pre-negotiate with investors. If you're aware of there's a tax cost, you can negotiate with the investors to at least get someone to pay for the tax costs, right? If you're not aware of it, then blindly walk into the deal and later on you get audited by tax authority, then you as a US company or US founder gonna be, or founders or investors of the US company have to deal with that. So again, you know, as you thinking about this structure, you have to think a few steps ahead before you execute. Next page. So last but not least, the third question, what was geared towards, and I thought it's important for people to see this chart a little bit, is really if you are starting up a brand new startup company, and there are investors clearly from China is interested, but you really don't know what the direction you're gonna go from beginning. And then at the same time, you still want to have variety of flexibilities, including keep the company in one structure, and being able to raise money both internationally as well as in China. Then this is probably one of the strategy for you to consider. And what this is illustrating is to have a Cayman entity as a holdco, but it's treated as a flow through for tax purposes, US tax purposes. And Hong Kong has a circle in it, again, is indicating that's a flow through entity as well. So with that, you almost set up a mini fund itself. You yourself, instead of set up a company, and you set up a mini fund, like an angel fund. And within that angel fund, you have two portfolio companies. One is this US company, and the other is the China company. And then in that mini fund, you will raise money at the fund level, as well as at, you know, the lower tier China portfolio company level, to keep that flexibility available for fundraising at the initial stage. The point here is this structure is flexible enough from accounting perspective. If you eventually find out, hey, I can go public globally using a global structure, very quickly we can take that Cayman entity, close up that flow through treatment, and package it. Because all the entities are within one consolidated group, you can get auditor to issue a consolidated financial statement and can go public in Hong Kong and US market. And if flip is true as well, because Cayman and Hong Kong are flow through structure. So if later on China become much more prominent, it's fairly easy for us to roll the US under China and just have China become a listco. All the US investors will get one level tax treatment, it's capital gain treatment. So you don't have blockers causing some complications in between. So that's, I mean, I'm sure there are other solutions out there for this type of situation, but from a tax perspective, this is what we see as the most flexible structure. And we certainly have implemented similar structure in that company. I mean, I think my first client implement this structure, let me see, probably it was started in 2011. It went public in the US first, and then now do listed in Hong Kong. It also spin off different elements for potential China listing as well. So again, this is one structure I want to share with the group. So I know I've been keep talking, and this is supposed to be workshop. To the extent you guys have questions, please feel free to jump in with questions. Okay, you use chat room to ask questions. If you let me talk, I can talk forever, and it may not be as useful or purposeful. So please use your chat function and submit your questions. With that, I know the next slide is a little bit more about tax reporting requirements for US investors. Carrie, you want to take us through what this is about?
Sure. So whenever you as a US person hold equity interest in a non-US corporation, there are two things or two issues or two type of entities you should be paying close attention to. One is called controlled foreign corporation, and the other is called PFIC, passive foreign investment company. Then even if you have not been in the situation where you hold stocks in a company that is determined as a CFC or a PFIC, you might have heard these terms from your LPs, investors, because we've seen a lot of the US investors would put certain words in the agreement that either the fund or the company, the portfolio company, shall provide the CFC or PFIC status on annual basis to the LPs. Then the question is really, why is the US LPs requesting such information? That's because two reasons. First reason is that you could call being a shareholder in a CFC or a PFIC might cause the US person have immediate tax impact, meaning have income inclusion on annual basis before any realization event happened. So certain people say, oh, I did not sell any of the stock. I know, but based on the US rule, because you are a shareholder of these two type of entities, then it could cause you to have immediate income inclusion. And secondly, it could cost you to reclass some of the long-term capital gains at future disposition to be ordinary income. For individuals, that's a huge tax rate difference. So these are the two reasons why the US equity shareholder of a foreign corporation, as well as all these US investors, pay close attention to the status of a foreign company. Then I will quickly go through how these are determined and who would be relevant, but I know we're running out of time. Anyways, so a CFC has the key word here is controlled. So it's controlled by a US or by many US shareholders who are actually holding 10% or more of the company's voting or equity shares. So there's a requirement. First thing first, you have to be a 10% US shareholder, and then your share would count towards the CFC determination. And thanks for Trump, after the tax reform, the rules have been more complicated. So in the middle chart, you can see in the middle chart, we have these two little right dot arrows. That's because we want to show that in a normal case, when you set up a structure like that, it's pretty commonly seen that Vivian just showed you with a US subsidiary. Even if you say, hey, I have a Cayman parent company, US is my subsidiary, but sorry, because of the US subsidiary, other than the Cayman parent, all the parents, all the sister and brother companies will be treated as a CFC. So if you're a 10% US shareholder sitting above the Cayman parent co, it could cost you in the same situation as if you're actually controlling the corporation. So this is the thing that we should pay attention, because I think we've been talking about, oh, I started business in the US and I try to go out of the US, but this rule is actually pulling you back to the US as a US taxpayer and ask you to pay tax immediately.
And I just want to chime in this structure. And I'm certainly I cannot share names, but this structure is actually very, very commonly seen, especially in the Chinese community right now. Why? I think a lot of Asian companies, even though the founders doesn't necessarily own 50%, but often they do at least have 10% voting rights. And in some circumstances, company go public, they will negotiate super voting rights. So the fact to be a 10% US shareholder only require voting right, very quickly founders could be in that category. And if your business is global, you have one US sub and you can have 100 Chinese entity or international entity, all those entities are considered CFC, even though the top entity is not. And what that means is you as a founder who has more than 10% control will be responsible for US tax filing on the 100 non-US subsidiaries and pick up income on your individual income tax return. This is happening quite a lot. There has been lobbies to change this law, but IRS has been, and the legislators has been pretty clear they're not going to close that issue. So certainly things to watch out for, and if you're in that scenario, we definitely need to plan around it. Yeah. So I know PIF is another rule. Carrie, you want to quickly talk about that? I mean, key is really the penalty provision, right?
Right. The PFIC rule is really when you're not a 10% US shareholder, but you still hold equity interest in a non-US company, then you should watch out for what assets is being kept in these entities, because the first test will be based on the consolidated financials. Then you will say, no, my company are having operations in China. But if you have investment money coming into Cayman, and for some reason the money was not contributed down or was not even spent before the year end, you accumulate a lot of cash at a consolidated level, you could still trigger the PFIC status. Just keep in mind the CFC and PFIC status are really at entity level. So it's not like whether you are, sometimes it's not you are the determination of these status. It could be somebody else because they have control and determine this is a CFC, or because, like I said, the cash accumulated at the Cayman level, it impact the company as a PFIC. So we just have to watch out. Just don't think that, hey, I'm not in that picture, but you are always one of the players in this situation.
Yeah, I mean, the reason we want to point this out is because this community very often the structure is Cayman holding, and when the Cayman holding structure take place, the U.S. tax filing responsibility go from the corporation to the individuals, okay, and often to the founders, okay. So just be aware, any of these compliance have heavy non-compliance penalty. I actually have a client got $5 million penalty, and they had to hire lawyers, spent $1 million in legal fee to reduce $5 million to $1 million penalty. So in any case, it's an important area to deal with. So with that, honestly, your investors, most of the funds do have US people in the back. So even you don't care about it, other people would care about it. Just something you just have to be aware of. And just plan ahead or just deal with it, reporting it. That's all you need to do. So with that, I mean, we want to just spend maybe 5 minutes on what's going to happen with U.S. tax law. And that's why my job is so exciting. And I think I will always have a job security is because tax always change, right? So especially U.S. tax changes in the recent years on a frequent basis. So we just had House Ways and Means Committee report came out, and certainly Biden on his campaign trail has put out some of the high level objectives from a revenue raising perspective in terms of his tax bill, which is very aggressive taxing increase. Zoe, please go ahead for another slide. Next page. Yeah, so this new bill is actually very long, quite a long, few thousand pages, but we, we have shrunk it down to these bullet points, which I think is relevant for startup company as well as founders to understand. So, well, what's relevant here is current corporate tax rate is 21%, essentially a flat rate. There's a small percentages at a 20%. But under this new proposal, and very likely the proposal by and large will stick if they want to pass it by the end of the year, because the amount of money and resource they have put in to put this draft together has been tremendous. For Democrat to craft something different or significantly different before year end, it's going to be relatively difficult. So we think this, if they want to pass something, these things might be pretty much it. Okay, so corporate in this new bill actually will go down for the first 400,000. There should be a K. It's not $400. It's 400,000 taxable income, and then for the next bracket, it still will stick with 21% up to 5 million. And anything above 5 million will be subject to 26.5%. At the end of the day, we think they might still pick a rounded number, 25% or 26%, 26.5%, just challenging our mathematics skills. But it's in that range. And if you follow tax, this is actually much better or lower compared to Biden's goal, which is increase the corporate rate to 28%. GILTI, what is GILTI? All that is about a U.S. company has foreign subsidiaries or U.S. individual has foreign subsidiaries. Under Trump's tax system, they force the U.S. corporation to pick up foreign subsidiaries earning and pay tax on it. But they give you, they give you a carrot when they give you this penalty. The carrot is, okay, yeah, I force you to pay tax, but I only want you to pay tax at half of the U.S. corporate rate, which is 10.5%. So right now, corporate rate is 21. If you're foreign subsidiary earning, paying tax in the U.S. is 10.5%. Now, under this new proposal, this rate could go up to 16.562%. Again, messy mathematic calculation. It's all that is due to this whole complicated calculation around deductions. Okay, there's this Section 199 Cap A deduction. For those of you who actually have pass-through investments, for example, real estate, if you run a small business, or what else? I mean, yeah, I mean, mainly those, I mean, for this community, probably mainly those activities, then you can get additional 20% discount or 20% deduction on your earnings for pass-through income. So up to $400,000. And last but not least, significant part is foreign tax credit for a lot of U.S. corporations have foreign subsidiary. For example, in China, you have foreign subsidiary. If you have foreign tax credit, you cannot use currently the current carry forward is 10 years, but going under the new proposal will shorten to 5. So, and there will be a whole list of rules to make it very difficult to take foreign tax credit as well. So we're doing quite a lot of planning for companies to take advantage the last year, how to maximize foreign tax credit in 2021. On the individual side, I will, Carrie, you want to quickly go through some of the key elements?
Sure. The individual tax rate currently is 37%, and we'll likely go back to the pre-Trump time, 39.6. But for income above 400K, I think for a lot of the startup, high-level management, it could be subject to the highest rate. And to increase the top capital gains tax rate to 25%, currently it's 20%. Viven, correct me if I'm wrong, I think the threshold to reach to 25% is $1 million.
Yeah.
So anything above $1 million, that's going to be 25%. Then, of course, for high net worth individuals, the government imposed 3% surtax for adjusted gross income in excess of 5 million. Be careful on the term, because this is saying adjusted gross income. That's a combination. That's basically on 1040, the bottom line of the first page. That's a total income, including capital gains and ordinary income. It's not like one type of income. So that amount, it could be easily reached if there are any exit, you're disposing your company stock. Then the next thing is the investment income tax. That's pretty much 3.8. I think they're going to increase by 0.05 or something like that in the next couple of years. But it's around like 4% on the taxpayer who makes more than 400K. Then the last but not the least, I think for most of the this crowd we will not very actively putting our assets into a trust. I think this is the time we think about that, because currently it's 11 million exemption for estate tax planning to just basically put your stock into a trust, and that's totally tax exempted. But after this year, it could go back to 5 million only. And think about 5 million is not a lot. So if you want to do something, that now is the right time to do it.
Yeah, I mean, there are certainly a lot of different rules that come into play here, right? So, yeah, at the same time, I would say you don't want to put all your assets in and give it away. You still want to plan around in terms of what do you need to sustain your lifestyle. But regardless, this is a year of change from a tax law perspective, and our prediction is Democrat will do everything they can to pass something by the end of the year. So, you certainly, I mean, especially on the individual side, you should be talking to your accountant to see, is there any of the things you can do to accelerate income, defer expenses, put things away, and also, reconstruct your mix of investments, so you're not getting the hit. So with that, I mean, for the next 10 minutes, before I know we only have 10 minutes left, we have a few slides about China tax considerations, but before we dive in, I just wonder, should I just stop and see if there's questions? Because
there is a question again. This question is asking about if there are any best structure for companies in terms of flexibilities to go on IPO in the US, Hong Kong, and Singapore. So
US, Singapore. Yeah. So I think if to answer that question, I think if you currently is a depends on whether or not the company already set up. I think we going back to the slide, Zoe.
Structure 3, Zoe. Go back to the structure number 3.
Page 6.
Okay.
Yeah. So page 6 is the structure I would potentially recommend if you are also debating or potentially need to attract Chinese investor. But otherwise, Zoe, why don't you just go to page 2? Yeah, so if you're not concerned about fundraising in China, you could just go to the structure 1 to start with. Keep in mind, US company just very, very, very difficult to go public outside of the US. It's just not a desirable structure. It's not a tax issue, it's mainly a legal issue. Okay, so if you want the maximum flexibility for all exit strategy, Cayman will be the structure you want to deal with. And you only go to page 6. Zoe, go page 6, please. You only adopt this structure when you think it's more likely than not there's going to be a Chinese investor involved. The investor, at least in the short run, may not be able to get money out using and get foreign direct investment approval. Okay, and there's also a possibility you want to retain a chance the China entity could go public in China as well. So this is the structure give you the maximum flexibility. It's US, China, Hong Kong, and Singapore. Okay, so I have seen more and more people is telling me they want to replace Cayman as Singapore. Is that possible? Absolutely possible. And it's probably desirable from a legal perspective in some circumstances, just because Cayman nowadays has economic substance requirements, and some of the jurisdiction, especially Europe, gets very, very sensitive for Cayman structure. So you might run into investor concerns if the holding company is Cayman, if you try to raise money from European investors. So there are some of the deals being done directly using a Singapore holding structure as well. So this entity can be Singapore. Now, Singapore is a jurisdiction with tax. So different from Cayman, is essentially a tax-free zone. There's no tax in Cayman, but Singapore does. So if you're using Singapore, you should be fully aware of what that tax means. There's many ways to get around it because it is territorial system, but still you need to follow those rules. Maybe with that, Zoe, go to the China section. I will just quickly talk about, there are a lot of incentives available in China. I would say China has been, in the past a year and a half or a few years, has been very, very focusing on instituting tax laws to facilitate and attract talent, as well as technology company, to support technology company, whether or not it is a semiconductor industry or biotech industry. So hire new technology company region is the biggest piece, but the trick is you are required to own IP in China. And historically, there are advisors will tell you can put certain IP, there are not full IP, but you just tell the authority you have some IP just by legal registration. The laws are all catching up very quickly. Tax authority in China know this is happening. They're just pick and choose when to audit you and when to apply the rule. But if you are a company naturally going to be focusing on China market, and then IP will be there anyway, then certainly this incentive is very, very powerful. Reduce the headline rate to 15%. It give you super R&D deduction, can reduce your tax rate further down to single digits if you spend a lot in R&D. And the next 2 pages, maybe go to page 13. Page 13, yeah. The few regions currently have biggest sort of incentive for executive, and that's very, very important as to you know, if you try to attract talents, especially returnees back to China, and especially also people exploring China IPO. So China individual income tax rate is actually very high, extremely high, and it's actually very hard to qualify as capital gains tax for a lot of entrepreneurs hold stock, because you typically have to hold stock not in your personal name, but through certain sort of a platform. So your individual income tax could be as high as 45% or minimum 33% on your future gain. So if you are in the position that you are really exploring China as your hub and potentially go to China for IPO, you should be thinking about these jurisdictions, negotiate ahead of time incentives. So allow your executive, especially the returnees, to enjoy these low income tax. That I can assure you that will help you to attract a lot more people from California, thinking about, you know, California tax and federal tax, and combined could be more than 50%, and in exchange for 15% tax rate. Certainly, you know, you suddenly increase your whole compensation package by significant amount. So these are the jurisdictions currently offer variety program based upon your industry, based upon your investment level as well. Last page, page 12. I'm not going to go into detail. Zoe, page 12. Yeah, and I listed here are things that when you go in and negotiate, what you should be asking for. You know, many of these things, as you can see, is not tax related. So local government has, you know, sort of a flexibility to give you variety type of incentives, okay, or subsidies. So if anyone's asking you to go there, you know, the basic incentive package should cover most of these topics. Let's put it that way. And certainly we've worked out a lot of that. And I know JJ Lake, certainly, you know, your team must be familiar with these setup as well. So with that, we're pretty much at the top of the hour. On this deck, I can share the deck with the team as I promised you for that. So don't worry, we'll share the deck. Anything else?
Yeah, I mean, since we get are we getting another question here? So, Vivian, do you have a few more minutes to answer this question here? So
which question is it?
I will read the question here. So the question is from Ning. For the case that to change US IP with a Chinese investment, how likely is such practice going to get an investigation from US authorities? How the founders consider investigation under current political environment?
Yeah, so what you are talking about is about export control. So I mentioned about, you know, in terms of tax issues when you transfer IP. But on top of that, there are legal ramifications. You need to first understand what IP you have, what kind of string attached, especially if your IP was originated from another institution, whether or not it's another college, Stanford, or whatever it is. You want to make sure, read through what those terms are, right? Even it is your IP, meaning the company IP, it's not your IP, individual IP. So if you somehow just moved IP out and the share become the individual in the individual name, that certainly violates not only, you know, sort of IP export control rules, there's many other rules you might be in violation to, corporate law, etc. And then on top of that, you know, export control is critically important. China just published their own export control rule. I just want to give you some advertisement. I'm actually hosting a webcast on November 16th through Deloitte webcast. We will talk a little bit more about export control rules on IP between US and China and solutions. But yes, you need to get legal team involved before doing any of that. Then the tax people can solve you, you know, before you understand that IP is allowed to be licensed out or contribute out, then we can talk about what's the tax consequences.
Thanks, Vivian. That was quite a informative session. And thank you for covering such a sophisticated topic for all of our audience. As Vivian was talking about the taxation in China, and just a quick shout out here. So JJ Lake has a very close connection with Suzhou Industrial Park. So for startup who want to set up a local operation in Suzhou, feel free to reach out to us. Well, as we're running out of the time, I just want to ask Vivian and Carrie one last quick question. So do you guys think at what stage the founder should consult the tax professionals? Is it like a pre-fundraising or like as in the middle of the fundraising, or once they actually close the deal and form the joint venture at what stage?
Well, I think certainly I would say before you actually put together the entity. So if especially if you think this is going to be a very serious transaction, then yeah, I would say before the entity is formed, you should consult with tax and finance advisors to understand which entity to accept money, what type of entities accept money, and how to fund the entire operation, especially your operations global.
So always think ahead. All right.
Yep.
Thank you very much, Vivian. Thank you, Carrie, and also thank you, Zoe. Also, I would like to say thank you to all of our audience who stayed until the last. And just a quick shout out about our upcoming events. So we will, since it's approaching the holiday seasons, so we're thinking of hosting other 2 cross-border events. So right now, I'm thinking of hosting one about how to distribute the founders' shares, how to set up the option pools, etc. And also another one probably focusing on the team cultures from the cross-border perspective when you're as a founder running a cross-border team, how to make sure to glue the team together. I think that's a very important topic too. But also, if you have any suggestions, feel free to reach out to me. And also, if you ever need tax advice, feel free to reach out to Vivian's team. Thank you all very much. You have a great night.